In this video, we are going to talk about dividend growth stocks. So before starting this video, please like this video and subscribe to this channel for our future updates. One common mistake that dividend investors make is chasing high-yielding stocks when they should be looking for dividend growth stocks that can provide years of consistent income increases. Because of the power of compounding, a dividend stock with a low yield yet rising annual payouts will outperform a high-yield stock with a flat payout. According to Argus Research, a high current yield raises the stock's interest rate risk, while an exceptionally high yield may also indicate that the business is failing and the dividend is in jeopardy. Argus Research's John Eade, Director of Portfolio Strategies, and Jim Kelleher, Director of Research, write that, while the income seems appealing, the share prices of high-yield stocks could be at risk. In reality, if interest rates rise, risk-averse equity investors will be drawn to the relative safety of bonds and sell their high-yield stocks, says the study. Argus Research favors dividend growth stocks with lower yields, usually in the 1.0% to 2.5% range, with some exceptions, of course. Although the yields are not especially high, as profits rise, management teams will be more likely to increase payouts. The aim is to identify companies whose dividends are rising higher than the market average over time. According to Eade and Kelleher, such companies are primed for outperformance. Number 10. AbbVie. AbbVie, AbbVie, $80.67, is a pharmaceutical firm that was spun off from Abbott Laboratories in 2013. It, like its parent, has a long history of dividend growth. What's more, AbbVie has some blockbuster drugs on its hands. AbbVie has increased its annual delivery for 49 straight years, even during its tenure as part of Abbott, with the most recent increase reported at the end of October. AbbVie announced a 10.2% dividend raise for 2021, with the first dividend due in February. According to Argus Research, the company has increased its dividend by 20% on average over the last 5 years, prior to this increase. And, based on the latest payout, AbbVie stands out as an exception to Argus low-yield preferences, with a yield well above 6%. Number 9. Illinois Tool Works. The 18% long-term payout growth rate is also a plus. Foster Refrigerators, Acme Packaging Systems, and the Wolf Range Company are among the companies owned by ITW, which manufactures building materials, car parts, restaurant equipment, and more. Illinois Tool Works is expected to produce strong profit growth in the coming years, according to the experts. For the next 3 to 5 years, they foresee annual earnings growth of 11%. Nonetheless, at 26.5 times next year's earnings, it seems to be a little expensive for most investors. Part of the reason for analysts' average recommendation of hold is valuation. They're still worried about the global economy's expansion. Number 8. Sherwin-Williams. The Argus Dividend Growth Fund has added Sherwin-Williams, SHW, $692.09. Its decision is no doubt influenced by the fact that it has raised its dividend for 42 consecutive years. SHW is one of the world's largest paints, coatings, and home improvement firms, having purchased Valspar for $11 billion 3 years ago. Baird Equity Research rates the stock as outperformed due to the company's size. SHW is benefiting from the growth of the do-it-yourself movement as well as macroeconomic power, according to the company. Sherwin-Williams's consistent and growing dividend stream is reassuring to income investors. Since 1979, SHW has increased its dividend every year, including a nearly 19% increase in February 2020, and it pays out just 27% of its earnings in dividends. Number 7. Abbott Laboratories. Abbott Laboratories, ABT, $105, is a pharmaceutical company that produces and manufactures branded generic medications, medical equipment, nutrition, and diagnostics. Similac baby formulas, Glucerna diabetes care products, and iStat diagnostics instruments are among the company's products. According to Argus Research, this healthcare company's yield of 1.5% is in the sweet spot for the portfolio. But perhaps the most compelling aspect of this stock is its legendary dividend growth track record. ABT's management has raised the annual payout for 48 years in a row, and the company's 5-year dividend growth rate is 13%. It's an understatement to conclude that management is committed to returning cash to shareholders. Abbott Labs was the first company to pay a dividend in 1924. The most recent dividend increase was in December, when it increased by 12.5% to 36 cents per share. Number 6. Kroger. This consumer staple company's 2.1% yield is in the sweet spot for the portfolio. Management has raised the annual payout for 11 years in a row, Argus says. If you need more evidence, consider that the country's largest supermarket chain has a relatively new fan in Warren Buffett, a well-known dividend devotee. Berkshire Hathaway, BRK. CEO Warren Buffett made his first investment in KR in the fourth quarter of 2019 and has since increased his holdings. With 21.9 million shares outstanding, or 2.8% of Kroger's total stock, the holding firm is also the company's sixth largest shareholder. It's easy to see why income investors are drawn to this stock, which has an 11-year track record of uninterrupted payout hikes and a dividend growth rate of 12%. The bottom line is also on track to rise profitably. Kroger is benefiting from more people eating at home, according to analysts, and it isn't getting enough credit for its burgeoning online market. Number 5. Costco. While this retail company's yield is low at 0.9%, management's 5-year dividend growth track record is 12%, and average annual returns over the past 5 years have been 21%, Argus analysts report. Keep in mind that, after dividends, Cost has produced a total return of 158% over the last 5 years. The stock would have only gained 133% if dividends were not taken into account. Sure, the yield is low, but it has added 25 percentage points to investors' returns over the last half-decade. In April, management increased the dividend by 7.7% to 70 cents per share. Bullish analysts also point out that, while shares aren't cheap, they're also not completely priced. While long-term risks remain watch points, such as renewal rates from the recent membership fee price increase and the threat from Amazon, write Stifel analysts, we retain our buy rating because we believe current valuation offers moderate downside security. Costco is expected to increase its earnings by about 10% per year on average over the next 3 to 5 years, according to Wall Street. The average analyst recommendation is buy, with 14 strong buy calls, 7 buys, 10 hold ratings, and 2 sells. Number 4. Microsoft. When it comes to share price results, Microsoft, MSFT, $204.72, has been such a clear winner that it's easy to forget what it's achieved for income investors. Argus Research, on the other hand, has been paying attention, noticing that the tech behemoth has increased its dividend every year for the past 16 years. Even better, MSFT has enough financial resources to continue raising its stock. Apple can get all the publicity for its massive cash reserves, but Microsoft is no slouch either. In each of the previous 2 years, the company provided more than $30 billion in free cash flow after paying debt interest. Microsoft already has $138 billion in cash and cash equivalents on its balance sheet. The company's execution and profit opportunities have the majority of Wall Street enthralled. Microsoft is expected to increase its earnings by nearly 13% annually on average over the next 3 to 5 years, according to analysts. Number 3. Clorox. Clorox, CLX, $208.73, is a recent addition to the Argus dividend growth portfolio. According to Argus, the cleaning products company has increased its dividend for 42 years in a row. Despite the fact that Clorox has a superior track record of dividend growth, a big surge in the stock price has prompted a number of analysts to take a pass. CLX is up around 40% year-to-date, thanks to pandemic demand, which has made the stock too expensive for some investors. Indeed, shares trade at 28 times next year's earnings, despite analysts expecting earnings to grow at a rate of less than 5% annually over the next half-decade. 3 analysts covering the stock for S&P Global Market Intelligence have it rated as a strong buy, 8 have it rated as a hold, 2 have it rated as a sell, and 2 have it rated as a strong sell. Number 2. Apple. Some stocks have excellent dividend and earnings growth potential. Take, for example, Apple, AAPL, $115.32. The iPhone maker is a part of the technology dividend parade, according to Argus Research, with a 5-year dividend growth rate of 10%. Meanwhile, analysts such as Argus Research predict that Apple's earnings will rise at a rate of more than 11% annually over the next 3 to 5 years. That's impressive for a business whose market cap routinely exceeds $2 trillion. Users are expected to update their iPhones in unprecedented numbers following the announcement of the new iPhone 12. With the May dividend payout, Apple raised its dividend by 6.5%, and its iconic cash position gives it plenty of space to keep raising it. Number 1. American Water Works. Most utilities pay dividends, says Argus Research, but few, other than American Water Works, AWK, $152.16, raise them at a double-digit rate, a 10% 5-year average annual pace that more than makes up for its modest current yield. Janney recently downgraded shares in American Water Works, but not because there's anything wrong with the company. If anything, AWK stock is a victim of its own success. AWK shares have risen 30% this year, Janney says. The performance has been exceptional. The outsized move by AWK to the upside is likely reflective of what we believe has been a flight to safety, given the company's long track of earnings performance and strong execution against strategic plans. With AWK shares now trading above our fair value estimate, we've reduced our rating from buy to neutral, hold, based on valuation. The elevated share price has prompted some Wall Street pros to moderate their bullishness on the name. And so new investors might want to wait for a better entry point. What do you think about our video? Have you got profit from investing in stocks? Let us know in the comments below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.